I always assumed my bank was on my side, a safe place to keep my money. Sounds like a golden rule of finance, right? Nope. That assumption didn't come from some deep financial wisdom. It came from inertia. Then one Saturday morning, I actually did the math. I pulled up my statements, opened a spreadsheet, and calculated exactly how much my big, traditional bank had cost me over the last year. Between the sneaky fees and the joke of an interest rate they paid me, the final number was genuinely shocking. Your bank is likely doing the same thing to you right now, and they're counting on you never looking too closely. They are secretly making you poor. I'm going to show you exactly how they're getting away with it, and the simple switch I made that stopped the financial drain and, for the first time, actually started paying me. It starts with a slow bleed, a series of charges that seem small on their own, but are carefully designed to add up. This is death by 1,000 fees. First up, the most common one, the monthly maintenance fee. My bank was charging me about $15 a month just for the privilege of holding my money. That's $180 a year for a service that should be free. Now, banks will tell you this fee is easy to waive. You just have to maintain a minimum daily balance of several $1,000s or set up a specific direct deposit. But isn't that really just a penalty for not being rich enough? They're holding your money hostage to avoid a fee that shouldn't exist in the first place. Across the industry, these fees at large banks can average over $16 a month, but it gets worse. Next is the overdraft fee. This is the financial world's version of kicking you when you're already down. If you miscalculate and your account dips below zero, even by a few dollars, the bank slaps you with a massive penalty. While the average overdraft fee has come down, it's still around $30 per occurrence at many institutions. Let that sink in. You might buy a coffee for $5, accidentally overdraw your account, and suddenly that coffee costs you $35. That's an absurdly high price for a simple mistake. And let's not forget the ATM fee. The simple act of accessing your own cash can cost you money. If you use an ATM that isn't part of your bank's network, you get hit twice. The ATM owner charges you, and then your own bank charges you for using an out-of-network machine. Together, this can easily cost nearly $5 for a single withdrawal. It's a convenience tax, and it adds up incredibly fast. Individually, you might brush these off. A few dollars here, a service charge there. But when I added everything up, the picture became infuriating. Here's what my year looked like. The monthly service fee was a guaranteed $180 gone. That year, I made one mistake and had a single overdraft, another $30 or so. I'm a busy person, and sometimes the most convenient ATM isn't my bank's. I figured I used an out-of-network ATM maybe twice a month. At about $5 each time, that was another $120 for the year. When I hit sum on that spreadsheet column, my jaw dropped. I had paid my bank over $330 just in basic fees. I wasn't taking out loans. I wasn't doing complex trades. I was simply trying to keep my money in what I thought was a safe place, and I was being charged a premium for it. I sat there staring at that number, and that's when I thought, wait a second. They're supposed to pay me interest, right? But it gets worse. The shocking interest rate scam. This is the other side of the scam. It's not just what they take, it's what they withhold. Fueled by my fee discovery, I clicked over to my savings account. I had a decent chunk of money set aside, my emergency fund. I looked for the interest rate, the APY, and there it was, 0.01%, not 1%, not even a tenth of a percent, 1/100th of a percent. For context, it's very common for major national banks to offer rates this low on their standard savings accounts. So let's do the math together. If you have $10,000 in a savings account earning 0.01% APY, do you know how much interest you earn in an entire year? $1. One. They hold $10,000 of your money and give you $1. Now let's look at my full annual report card. I paid them over $330 in fees, and they paid me maybe a buck or two in interest. I was deep in the red. My money wasn't just being drained by fees, it was also losing purchasing power, getting eaten away by inflation, while the bank handed me pocket change. That's when I realized this isn't an accident. It's the business model. Why they do this? So why do traditional banks operate this way? It's actually pretty simple. They have enormous overhead. All those fancy marble lobbies, massive buildings, and thousands of employees, they cost a fortune, and you're paying for it. But the real money is made in something called the spread. They take your money, your deposits, and pay you next to nothing for it, like my 0.01%. Then they turn around and lend that exact same money out as credit cards with 22% interest, car loans at 8%, and mortgages. Their profit is that massive gap, the spread, between the tiny amount they pay you and the high rates they charge everyone else. They're using your money to make themselves incredibly wealthy, and then they have the audacity to charge you a monthly fee for providing the raw materials. It's a brilliant business model for them and a terrible one for you. If you're finding this valuable, and if you're as frustrated by this as I was, do me a favor and hit that subscribe button. It helps the channel and makes sure you don't miss more ways to take back control of your finances. So what can you do? Are we just stuck? Absolutely not. The answer is to fire your bank, or at least demote them. The solution lives in the world of digital banking, online-only banks, and modern fintech companies. Their advantages directly attack the two biggest problems. First, the fees. Most popular online banks charge no monthly maintenance fees, no minimum balance requirements. Many have eliminated overdraft fees entirely, and a lot of them will even reimburse ATM fees. They can do this because they don't have the massive overhead of traditional banks. But the second advantage is where things really change your financial life. High-yield savings accounts, also known as HYSAs. While my old bank paid me 0.01%, a quick search today shows many FDIC-insured online banks offering around 4.0% to 4.5% APY, with some even higher. Let's rerun the math on that same $10,000 emergency fund. Instead of earning $1 a year at a conservative 4.5% APY, it would earn $450. That's not a typo. $450 instead of one. Now look at the total swing. In my old banking setup, I was losing over $330 in fees and earning maybe a dollar, roughly a $330 loss every year. After switching to a no-fee online bank and moving my savings to a high-yield account, my fees dropped to zero and my interest jumped to $450. I went from a $330 loss to a $450 gain. That's nearly an $800 turnaround in a single year just by changing who holds my money. This isn't a trick. It's simply moving your money from an outdated system to a modern one. You don't have to accept a banking relationship that drains your wealth. You have the power to change it, and it's easier than you think. Here are your actionable steps. First, do your own bank audit. Tonight, log into your bank's website. Download your last 12 months of statements. Go through them and add up every single fee, monthly fees, ATM fees, overdraft fees. Get your number. Second, while you're there, find your savings account's APY. Look at that tiny percentage and calculate what your money is actually earning. Third, open a new tab and search Best High-Yield Savings Accounts. See the rates available right now. The difference alone will be motivation enough. You don't have to close your old bank entirely. Some people like having a physical branch for certain situations. But you should absolutely move your primary checking and savings to institutions that actually reward you. Use a hybrid approach if you want, but don't let your cash stagnate any longer. It's your money. You worked hard for it. It's time it started working for you, not for your bank's shareholders.